How's everyone doing tonight on this Saturday, August 22nd, 2026? You are in the strategy room here with the banker next door. It feels good to be back here on a Saturday night. It's been been a few weeks, but we are back and we are here. And I have a great show for everyone here tonight. Just buckle up. We got a couple hours of great stuff to go over with everybody. Some of you might find a little bit of this information a little bit depressing tonight, as we are going to be talking about the national debt and crossing the $40 trillion mark officially. A lot of interesting things happening this week. Obviously, the bond market going absolutely haywire. Scott Bessent, the Treasury Secretary, became kind of the man of the week. He was under a lot of pressure to do something, address the interest rate situation, address the bond market this week, particularly the long end of the bond market with the 30-year Treasury. So, Scott Best, we're going to talk a lot about that tonight. We're going to talk about what tools are in Scott Bessent's toolbox, like what can he really do to address some of this stuff. We're going to talk about the situation that the central bank is in, like what does the central bank do? What could their role be in this? What happens when we get to a point you do cross a threshold here when the debt gets to a certain point? You do get enter a realm of what's called fiscal dominance. It's something that I had touched on probably a couple months ago, but in other words, when the cost of servicing the national debt gets to X level, in other words, you have two sides of the coin, right? The fiscal is the government side of the coin, and the monetary is the Federal Reserve side of the coin. You get to a point where you have to spend so much money on the debt, it just becomes like the Federal Reserve can't really do anything. And so you really end up in a position of fiscal dominance where it's really all on the government to do something. Now, what will they do and how will they do it? I have a couple thoughts on that, but we'll hold on to that for just a minute. Some other interesting things that happened this week. I've got some kind of a hedge fund update. We're going to talk a little bit about that. The politics around the data centers and AI is really beginning to turn. So I have a kind of an update on some of the data center numbers. Last week, I talked a little bit about private credit. This week, I have another very interesting article about how they're going to now go after British market and particularly pensioners in the British market. So we'll get into that a little bit. Um, what else I got? I got economic indicators to talk about tonight. Trump had a very interesting meeting this week with some of the heads of a lot of the crypto bros, fintech bros, tech bros at the White House. That really set off some very interesting things in the market. Bitcoin had a very nice week rallying back because of that. There's also an exchange called Hyperliquid, and we're going to talk about this thing, this type of instrument that they have called perps, which I basically did an episode on probably about a month and a half ago. And the reason why I did the episode is because I knew that this was going to come up. I knew that this was going to be a bigger deal. And thus, there is a method to my madness, if you will, and a lot of the stuff that I cover. All this stuff, it all links. All the episodes that I do, the live stream here, it all connects. All this stuff comes together. Sometimes it might take a little longer than others, but it does work. So, all right. Let's get into a couple things here tonight. I'm going to jump in. Okay, now we're going to get to our debt clock here in just a second, but I wanted to lead off with a couple things here. So obviously the national debt hits the $40 trillion milestone. The national debt could cross the $50 trillion mark by 2030. Now, remember what I've told everybody, the national debt goes up by $1 trillion roughly about every 100 days. So that means within the next year, we're going to go up another $3 trillion. That means within 3 years, we'll be up over $9 trillion. And that's why they're saying that by 2030, we probably will hit the $50 trillion mark. Unless something very dramatic happens in the next couple of years, which I would highly doubt it. But let's see here for a second. So the national debt crossed the historic milestone of $40 trillion this week. It has been about 3 months since the federal government's debt hit 39 trillion, according to the Treasury Department's debt to the penny dashboard. Debt held by the public is about 32.2 trillion. The intra-governmental holdings are close to $7.8 trillion. So hitting this milestones comes firmly ahead of the Congressional Budget Office's baseline estimate of 2027. Looking ahead, using the nonpartisan budget watchdog's 7% growth rate scenario, the national debt could barrel toward the $50 trillion mark by 2030. The U.S. government is collecting a record $5 trillion in revenue nominally, but it is spending approximately $7 trillion, resulting in annual budget deficits of $2 trillion. Mandatory entitlement programs, Social Security and Medicare, for example, and surging net interest payments are accounting for a greater share of federal outlays. Yes, and we're gonna get to that in just a second. So I want to jump over to this. So U.S. debt has topped 40 trillion. How did we get there? So the US has hit a new borrowing milestone while debt as a share of GDP nears levels last seen during World War II. So there are some really good charts in this article right here. So the first one up is US public debt outstanding. So you can see here on this chart that basically we break the debt into two separate categories. We have intra-governmental debt, and then we have debt held by the public. And that's what I just commented on in the last article. So you can see here we have about $32 trillion in debt held by the public, and we have about another $7.8 trillion in intergovernmental debt. Now, when we scroll down here, because I want to show you this. So the path to 100%. So debt and deficits haven't always been a problem in the U.S. Publicly held debt now approaching World War II levels at about 100% of the country's annual GDP was just 31.5% of GDP in 2001, 25 years ago, after 4 years in which the government ran budget surpluses. So again, I want to take a look at this chart here. So U.S. publicly held debt as a share of GDP. So you can see here back in the middle of World War II, we were back up over 100%, but then we came all the way down here into the 70s, probably about mid 70s, 75. We hit our lowest level there, and then we went back up in the, or probably mid 90s, came back down after we had the dot-com error in the 90s. We have the huge market burst. Government was doing great. People were doing great. Everybody was making a lot of money right up until 2000 when we had what? The dot-com bubble burst. Then we basically saw 9/11, and then basically an absolute explosion ever since in debt back up to the upside. Now, I will say this, though. You can literally trace the expansion of the national debt back to one very key moment. In 1971, Richard Nixon did what? I'll give it, see if anybody can. Well, what did Richard Nixon do in 1971? See if anybody can throw anything up here in the comments. All right, yes, we got the first one. Ding, ding, ding. We got a correct answer here. Yes, he took us off the gold standard. So Nixon takes us off the gold standard in 1971, and our debt has done nothing but balloon ever since. Now, the gold standard was not perfect, but the main thing that the gold standard did was the gold standard was handcuffs, but it was handcuffs on a very particular group. Who was it handcuffs on? Well, that's right. It was handcuffs on politicians. Politicians had the handcuffs on, meaning that they were held back from the ridiculous debt that we now find ourselves in. And that's why politicians hated the gold standard. They hated it because they were handcuffed. People loved the gold standard because it kept the politicians handcuffed. But unfortunately, we have seen a lack of economic understanding. I would call it that way particularly over the last 50, 60 years in this country. And a lot of people have, the gold standard has become a very negative thing. People are like, oh, the gold standard, that's a relic from a bygone era. Like even though we did quite well under it for a long time, no issues. Didn't need a central bank or anything. Pretty interesting, but interesting conversation to have. So anyway, but getting back to our debt to GDP, our share of the GDP here, so you can see just how we've exploded up here. Now, I also want people to remember something else. There's two ways of looking at this. There is the debt, the consumer debt to GDP right here, where you're getting up to 100%. But then you also have the federal debt to GDP, which when we look at our debt clock, and I'll run to our debt clock for a second here, our federal debt to GDP is at almost 123%. So there's two ways that you have to look at that. So now let's get back to this article for a second because I want to scroll down here. Now, here is the annual budget surplus slash deficit as a share of GDP. So you can see here again, World War II, we go way negative in the worst. We're down almost, as you can see on the left here, we're down almost 30% by like 1945, but then we start coming back. And what's interesting is even during Vietnam, even at the height of Vietnam, we did not see, we did not see massive negative, annual surplus and deficits. We did certainly run some deficits, but it was like, again, nowhere near as bad as what was going on for World War II. Then in the 80s, we start running more and more deficits as Reagan was just like to spend a whole lot of money. Bill Clinton gets in here. Now, here's another interesting tidbit here. So you have these 4 years of the surplus, right? Well, yes and no. There are people out there that would argue that that surplus was perhaps not a true surplus, but basically maybe a little bit more of some fancy accounting gimmicks that allowed it to show as a surplus for a number of years. But look, that's neither here nor there. Let's put that aside. Let's just accept this chart as being accurate and saying, okay, yeah, we had this 4 years of surplus, which again, we did have a good 4 years at that point. So nothing bad there. But then you just see here for the last 25 plus years, it's just nothing but just running a deficit every single year. Deficit, 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 deficit. Now, um, and again, both sides have, whether it's Republican or Democrat, both sides have their pet projects, right? They both have their things that they love to spend money on. On the Republican side, Republicans, they love to spend money on the war machine. They love to spend money on wars, on the military industrial complex. They can't get enough of that. On the Democrat side, they can't spend enough on welfare and illegal immigration and just all kinds of cultural programs. They can't, Democrats can't burn the money fast enough. So both sides here are equally to blame, and both sides here have serious problems that have led us to where we are today. Now, we go to the outlook here. What's interesting here, so this is a composition of the federal spending as a percentage of GDP. Now, what do you notice here from this chart? Let's look through the categories for a second. We have in the blue here, we have payments to individuals in the light blue. In the perhaps darker, almost turquoise, we have national defense. And the orange, we have net interest. In other words, that's the interest that gets paid to service the national debt. In the black, we have other federal grants. And in the light blue, we have other spending. Now, you can see here that the other spending has really come down since, about 2021 during the COVID pandemic. That's come down. Other federal grants have come down as well. The net interest continues to widen and get larger and larger as the national debt continues to balloon. National defense still continues to go up, and they want to expand. Like I said, the Republicans, once again, want to expand that further. Spending $1 trillion is not enough. They now want to spend $1.5 trillion. Like, okay, but here is the big mammoth, the mamma jamma, the payments to individuals. And this is perhaps where we have by far and away the largest issues in our government, because if anything, if you've been paying any attention to the news in the last few weeks, that or last few months rather, is that fraud is just off the charts. I mean, fraud in all these different categories. There is so much massive fraud, it's unbelievable. And something has to be done to address the fraud, because it literally, I truly believe that the fraud is anywhere from 500 billion to $1 trillion annually of fraud. And I think that it's such a massive problem. Something has to be done to address it. Something has to be done to get really serious about it. The other thing is the ballooning welfare state, and I know that a lot of I know that right now in particular they'd probably tell you that, like, oh well, we're not really spending that much money on illegal, immigrants. However, I would be willing to say that no, they are, and that a lot of those individuals are still on our welfare system in some way, shape, or form. And this is just something that needs, and again, this is just, this spending here has just gotten so completely and utterly out of control. But you just don't have, the big problem here is you don't have a political will to cut this spending. You just don't. I said that back at the beginning of 2025. I said, for all the people out there that, when Trump came into office, it said, people are about to get a massive shock. They think there's going to be this massive cut to spending, that we're going to get back to a balanced budget, all that other stuff. And then what happened? As soon as Trump got in there, the House was like, yeah, nah, we're just passing CRs, just CR after CR. Yeah, we're not. And they have another CR. There's another CR that's going to be rolled out here in September. They're going to be looking to just keep the spending going and just keep kicking the can, down the road. Um, the problem is this. It's a twofold issue. Let's say hypothetically for a moment, let's say that Donald Trump did the things that he promised he was going to do when he come in. Say that the 25 million illegals that came into the country under Biden, say he rounded them up and sent them all home, right? And they cut this spending here. Say they cut, $1 trillion out of the spending here, right? Just to, and so we're still negative $1 trillion, but let's say they made a really big dent in it. You do those two things, do you know what's going to happen? You're going to end up in a recession, and housing prices are going to come down. Housing prices in that scenario would probably come down 10 to 20%. I would roughly estimate. And you would see the demand for housing drop. The prices would come down because the demand would drop, because you're removing 25 million people from the economy. So rents would come down, housing prices would come down. That would drive us into a recession. However, there is a giant however. I would argue that that would probably be the greatest recession that this country ever had, because coming out of that would be amazing. Because what would the Federal Reserve do in a recession? And what is the technical definition of a recession? That is back to back negative quarters of GDP is the technical definition of a recession. So we have a couple negative quarters. Say we have a whole year of negative quarters. We have a whole negative year. What is the Federal Reserve going to do? They're going to drop rates, right? Yeah, they're going to drop rates. So what's going to happen after you go through that mild pain? And it's a pain that would not affect most people in the way that you think it would. Yeah, there's a lot of people out there, they would take a technical hit to the balance sheet of their personal balance sheet, because the value of their real estate would drop. But it's not like it's going to drive all of these people into bankruptcy. It wouldn't. But what happens coming out of that? What happens? Oh, that's right. Houses are what? They are affordable again. Houses are available again because the demand has dropped. The interest rates have dropped. You've got 25 less million people looking for jobs. That opens up a whole lot of what? Job openings for what? The 7 million guys that are sitting at home on their couch right now. I did an episode about that if anybody wants to go check it out. So, but I think the problem is that we have passed that point. If Trump would have done that, and if he would have bit the bullet in year one and basically said, "Hey guys, we're going to have a bad year one here, but then this is all going to pop back coming out of this the next 2-3 years of my term," that would have been fantastic, and you would have seen the economy in the second half of his term. It would have boomed. And right about now, as we were getting ready for the midterms, things would have really started to blossom, and you would have, and Republicans probably would have won the midterms in a landslide, because they would have looked they would have, delivered on their promises. Everybody be happy. The economy would be in a great spot. But they decided not to do any of that. And now the problem is it's too late to do any of that. And now you're probably facing a situation where the Democrats are going to win the House here in a couple of, at least the House, if not the House and the Senate, here in a couple months. And then this whole thing is going to turn into a crap show. So um again, I'm just spitballing here on ideas, right? So, but the again, there's so much that has to be done to address this spending. And again, and like I said, my big fear is that you just do not have the political will to do it. Which is just, it's a travesty. It's an absolute travesty. And then you come down here, the crux of the problem, federal revenue as a percentage of GDP. You have individual income taxes, corporate income taxes, social program taxes. You have excise taxes, others, including tariffs. Um, but I see one of the biggest problems here is the corporate taxes. I mean, the corporate taxes are so ridiculously low. When you go back to, the start of, I know this goes back to like the 1960s, but you go back before that, you go back into the 30s, the 40s, the 50s, corporations paid the bulk of the taxes in this country. You go back into the 1800s, and individuals didn't pay all these taxes. You didn't have an income tax before 1913, before the Federal Reserve. You didn't have an income tax. And yet we still had bridges and roads and local governments and libraries and police forces and firemen and ambulance and all that. We still had all that. But yeah, again, you look back, and it was a much different tax system where we were getting all of our monies from tariffs and corporations. Individuals didn't pay a whole lot in taxes, and that was why the country had such a booming and robust economy for large swaths of the 19th century, and leading into the 20th century. So again, we could get into a whole conversation on that. I don't want to get off of that. And then we get into who holds the debt. So holders of the U.S. debt. So we have mutual funds, households, and nonprofits, banking, insurance, and pensions, Federal Reserve, state and local governments, and then foreign holders have a huge chunk. And then we have a little blue line at the bottom that has other. So that breaks it down, like who are the big holders of the national debt. And obviously, foreigners, mainly, Japan, China, a hundred other countries, all basically make up that 32.6% of our holdings by foreigners. Federal Reserve here is basically holding about 19.2% of our debt, along with state and local governments. Banks and pensions make up about 15.7%. And then mutual funds, households, and nonprofits make up 30.8% of that number. So, and then we'll come back to that in a second, the magnitude of the 40 trillion. And we're going to skip because I want to jump over to a couple of things. Now, here is an interesting article. How much has the national debt grown under Donald Trump? That's a good question here. So we can see here, just again, the growth of the national debt. You go back to 1990. Our national debt was basically about $4.2 trillion in that neighborhood back in 1993, all the way up to, again, $40 trillion here. So, but you can see here, peak U.S. national debt under Trump. Now, this is according to Kalshi, the predictions market in here, and they're basically saying that, they're predicting that, will we hit, up to $49 trillion? Probably going to get up there at some point in the not too distant future here. Let's see here, but this is interesting. So tracking the U.S. national deficit over time, and again, you can see here, again, we were at basically pretty close to about zero, running some deficits. They were kind of negative, but then, what happens? Again, Nixon takes us off the gold standard in 1971, and you can see that the spending just goes there. Now, we had some negative runs in the 80s and the 90s, but then it came back up here again in the late 90s into early 2000s, and then has basically been on a downward spiral here ever since, really plunging down to over 3 trillion during COVID, then bouncing back up to being negative 1.3 trillion in 2022, and now settling in at about 1.8 trillion dollars to the negative here as of today. So, but again, like, how much is Trump really responsible for this? Well, you could see here, again, 2017, when Donald Trump first came into office here, his first term, we were about $20 trillion in national debt. So since 2017, so basically, approximately in the last 10 years, we have doubled the national debt in just the last 10 years. It is doubled. Um, and here's the thing, you might ask the question, like, we go back to this article here, like, how do we get here? Well, how do we get here? How do we get all of this massive, national debt? Well, how do we get, where did all this come from? Where do we get all this? Well, we got it through a lot of things. What happened? Well, we had the financial crisis where a lot of people got bailed out. And again, this money doesn't even include the trillions of dollars on the Federal Reserve's balance sheet. We didn't even get to that yet. But again, this is forever wars in Iraq and Afghanistan, to the tune of $9 trillion that we spent there just on that alone. You've got trillions of dollars for the Wall Street bailout, 07, 08, 09. Then you have money from COVID. You have, I mean, again, these are just, that is what has just ballooned. All these things have just ballooned the debt up and up and up and up and up. And then we get to this. So Bessent says that there is a very good chance that the U.S. budget deficit under Trump has peaked. So Treasury Secretary Scott Bessent said Thursday that there's a very good chance of the U.S. has seen its budget deficit peak under President Donald Trump. The monthly U.S. budget deficit topped $432 billion in July. Bessent said the Trump administration is working on fiscal consolidation measures. Treasury Secretary Scott Bessent said Thursday there's a very good chance that the U.S. budget deficit under President Donald Trump has likely peaked. We are going to be laser focused, Bessent told CNBC's Sarah Eisen in an exclusive interview. The monthly U.S. budget deficit topped $432 billion in July, its highest level in more than half of a decade. The Treasury Department said last week that monthly report showed the gap for the fiscal year to date climbed to almost 1.8 trillion, above where it was at the same point a year earlier. The Treasury Department announced this week that the U.S. government debt pile to fund those deficits hit a new record of about 40 trillion. The total has more than doubled over the last decade, exacerbating concerns about the country's financial health. Bessent said himself, Trump and Russell Vought, director of the Office of Management and Budget, are among federal government leaders working on fiscal consolidation measures. Several hundreds of billions of dollars could be saved through these efforts. So, my issue with this is, why were you not doing this from day one? I guess that's my question. Why are you just laser focused on this now? I have been harping for months and months and months about the fact that there was no plan. Like, where was the plan to reduce the spending? Like, I mean, I know, and again, I want to give Trump some kudos here. He has dramatically reduced, I don't want to say maybe dramatic is too big of a word. He has reduced a lot the number of government employees, so he has had an effect on spending. Spending was over, over to almost 2.1 trillion when he walked in the door. He got that down to about 1.6 trillion deficit, but now it's back up to about 1.8 trillion. So I mean, so they did put a little bit of a dent in it by reducing the number of government employees. But that's about it, and that's about it. And what happened to Doge? Why didn't you follow through with Doge? Why has Doge been eliminated? They should bring back Doge immediately. And I would like to see Doge become a permanent, government operation office, however you want to describe it. Doge should be back, and it should be back permanent. And they should let Doge. They should give them a bigger group of people, a bigger budget, and let them go get all these fraudsters. Let them go get the fraudsters. So but again, why was this not a serious thing from day one? Why is it when, Trump should have rolled into office with a bigger plan on what he was going to do to address this? There should have been something there. And then, you know, but to be fair to him, he and his administration can only do but so much. Congress has to play a massive role in this. Congress is the one who has to cut the spending. Congress is the one that passes all the budgets and the CRs and everything. They have to get in here. They have to spend. They have to cut the spending. They have to do that. Congress has the Doge put forward all these cuts, and they didn't enact any of them. So where were all the Doge cuts? Where was all that enactment? None of that has happened. So again, this is all at the end of the day, really, it's just incredibly frustrating that is more is not being done here to address this, because this is now we're getting to a very real. We are heading like a train out of control. We're like, basically, think of us as like we're a train that's now going 120 miles an hour, 120 miles an hour down the track. We can't get off the track, and we're approaching a dead end at some point, and we continue to accelerate toward that dead end. And the lever is at the moment is broken, because Congress basically refuses to do anything to address the issue. Um, Now let's take a look at our debt clock here real quick. So, like I said, we've gone over this $40 trillion mark here, and we have the debt per taxpayer of $360,000. Again, now this is saying here that the U.S. federal budget deficit is 1.676 trillion, but we have other estimates saying that has jumped back up to $1.8 trillion. Again, that debt to GDP is at 123%. Interest on the national debt over $1.1 trillion and counting. That number is going to continue to balloon up. Again, defense spending right now at 946 billion, but they want to take that up to 1.5 trillion. Credit card debt still here at $1.363 trillion. That equates to a debt per holder of $8,363. So again, not fantastic numbers here. Now, let's take a look at some of the things. What were some of the things that happened this week? So basically, the stock market did not. It kind of bounced back a little bit yesterday, but the stock market has not had a great last 2 weeks. Like, things have been very up and down and all over the place. We can see here from bonds, the 30-year bond yield accelerating up to 5.72%. And when we look at the 5-day, we could see in this chart here, we could see the roller coaster ride and this isn't just the 30-year bond. This is all the bonds this week. But you can see here, we started off on Monday, the 17th, shoots back up way over 5.3%, almost gets up to 5.35%. Then basically Scott Bessent comes in to intervene, gets it to come back down. We see this drop here on Wednesday, the 19th. We get back down to about 5.193, and then Bessent says, "Okay, we're gonna do this new package for $1 billion, 400 billion, and we'll like I said, we'll get into that in a minute." And then, but of course, the market eventually shrugs that off and basically says, yeah, what is that going to do, man? That's like peanuts. And then the market continues to go back up here, right back up to 5.275%. So at least Bessent's tactics for the moment didn't really do very much this week, basically. And we can see here the 10-year Treasury has surged back up to 4.736%. Now, at the end of the day, I've talked about this before, what is causing this surge in interest rates? What is causing the bond market to react to this? Well, first and foremost, it's the fact that we hit $40 trillion in debt. And we're now at 100%, gross consumer debt to GDP. We're at 123% federal debt to GDP. We're spending over 1.1 trillion just to service the national debt and interest. That's starting to take a huge chunk out of the budget. And we are And we are barreling toward a much larger number. Just in like I said, a little over 3 years, we're going to balloon that up to $50 trillion. And then the amount, I mean, could you imagine the amount of interest that will have to be paid on $50 trillion if rates just say they just stay here? You're gonna be looking at two and a half, two and a half, maybe $2.7 trillion just to service the national debt. We take so I want you to think about that for a second. We're taking in how much are we taking in right now in revenues? US federal spending right now is 7.2 trillion. We only take in about, $5 trillion in revenue. So we could be paying out 2 to 2.5 trillion dollars. That could be half of the money that the government takes in every year. Half of the government that it's I mean, it's crazy. That is why the bond market is in part reacting to what they're doing. Now, what else, but what else is going on? Obviously, the conflict in Iran is not helping anything. That's playing a major issue in this. And you have a number of additional factors that are all playing into to driving this to this point right here. And again, it's not good. We can see here, and basically, I mean, all the rates basically went up this week. We got the 7 year up to 4.57%, 5 year up to 4.429, the 3 year at 4.32, the 2 year note at 4.24%, the 1 year at basically 4%. So again, these really jumping up. Now, let's say again, I'll mention just a second. Crypto had a big week this week, bouncing back up to 77,000. So it was a good week for crypto. And then we look at commodities again jumping up this week. The crude oil futures back up to $86.64. The Brent crude futures back up to $92.22. Gold popping back this week up to 4,661 because again, the turmoil in the bond market, gold is a safe haven, so people will jump over to gold in times of turbulence. Now, what happened with mortgage rates this week? So let's take a look at this. So mortgage and refinancing rates as of today. According to the average rates from the Zillow Lender Marketplace, mortgage rates are extremely volatile heading into the weekend. Two popular loan terms rose dramatically while another slid lower. A nervous bond market has mortgage rates scrambling. So the current 30-year fixed rate today, as of Saturday, August 22nd, rose 14 basis points to 6.64%. The 15-year fixed rate actually fell 12 basis points to 5.88%. And the 5/1 arm rose a whopping 49 basis points to 4.74%. Like, phew. So now what do we have here? So we got 30-year fixed at 6.64%, 20-year fixed at 6.37, the 15-year at 5.88%, and the 5/1 arm at 6.74%, and the 30-year VA mortgage at 6.14%. So again, mortgage rates really beginning to creep back up to that 7% range. Now, on the refinance side, 30-year fixed at 6.64%, the 15-year fixed at 5.99%, 5/1 arm at 6.5%, and the 30-year VA at 6.02%. So that's where the mortgage rates stand at the moment. I mean, again, not pretty, and not where we definitely not where we want things to go. Bank stocks, broader market tumble in one of 2026 worst weeks. So U.S. bank stocks and the broader market both declined sharply this week, but the KBW Nasdaq Bank Index fell 4.59% between August 13th and August 20th market closes, its second worst weekly performance of 2026, behind only the 5.9% decline recorded between February 26th and March 5th. The S&P 500 slumped too, sinking 2% between August 13th and August 20th market closes. The sell-off also snapped a 2-week winning streak for bank stocks and reversed the prior week's output performance against the S&P 500. But analysts are still bullish on bank stocks. While the KRE S&P Regional Bank benchmark dropped 2.4% on August 19th, 52% of the large and mid-cap bank stocks fared better, and 81% of small-cap banks saw single-day declines of less than 2.4%. So, yeah, and then it just has a chart here of some of the best and worst performing banks. But like I said, just wanted to try to give you that little bit of an overview for the week there. So now, let's talk about crypto and Bitcoin for just a second. So Trump has this meeting at the White House this week where he, like I said, he meets with all the crypto bros, the tech bros, the fintech bros. And then coming out of that meeting, tech really had a big pop because first and foremost, Trump was really pushing for passage of the Clarity Act. So Bitcoin surges 22% for the week as investor optimism floods back. So Bitcoin rose to around 77,000 on Friday, pushing its weekly gain to more than 20%. The rally began Wednesday when Treasury yields pulled back sharply following Besant's intervention in the bond market. Investor sentiment improved further on Thursday due to a last ditch push to pass the Clarity Act. So, like Bitcoin closed 22% with a weekly gain on Friday, following a spat of positive developments for the world's largest cryptocurrency. Bitcoin ended the day higher by 6% at 76,943, up from about 62,800 at the start of the week. Crypto linked stocks rose, with Coinbase advancing 8% and Strategy up 6%. The rally began Wednesday when the Treasury yields pulled back. But I would say it basically started before that when Trump had his, basically meeting at the. So investor sentiment improved further on Thursday, largely due to a last ditch push from the White House and crypto industry leaders to get the Clarity Act across the finish line in the coming weeks. The bill is widely viewed as a key catalyst that could push the market out of the crypto winter that began last fall, but the chances of it passing appear relatively slim. Yes, I would concur with that. So, and then we get to call buying bonanza around Trump's hyperliquid comments includes some eyebrow raising trades. So Wednesday was already shaping up to be the best for crypto assets in recent memory, with Bitcoin trading the highest since June as President Donald Trump scheduled a meeting with industry leaders. Then the big news hit. Around 3 p.m., the president hinted at regulating Hyperliquid, the decentralized exchange that's been garnering popularity among traders as the home base of perpetual futures trading, the swap like derivatives contracts with high leverage and no expiration that have been a thorn in the side of incumbent exchanges this year, despite U.S. residents not being allowed on the platform. I understand that Commodity Futures Trading Commission Chair Mike Siegel is also working to bring Hyperliquid into the United States in a fully compliant and legal fashion, Trump said in a press conference. Shares of Hyperliquid Strategies, the publicly traded treasury company that owns Hyper tokens, surged 30% before the closing bell, bringing the stock's year-to-date gain to more than 163%. Hype, the digital token that powers the exchange blockchain-based settlement and operations, jumped 18% to just below record highs. Shares of the CBOE Global Markets dropped 3.5%. Miami International Holdings shares fell 3.1%, and CME Group shares slid 1.7%. We've been trying for a while to figure out how to get into the US, and the CFTC has been quite responsive. But when Trump says it in a press conference, it means it's a priority. David Shamus, CEO of Hyperliquid Strategies and founding partner at Atlas Merchant Capital, said in a call after the bell on Wednesday, you can't do something like this and make new rules. You see how hard it is to get the Clarity Act passed. You have to figure out how to make it work with rules existing today, he said. The Clarity Act is a bill that would establish a regulatory framework for cryptocurrencies. Yeah, options volume in Hyperliquid was almost 8 times the 30-day average, with more than 120,000 calls trading versus under 8,000 puts. Traders bought almost 45,000 calls and sold 29,000, about 10 million in premium exchanged hands, with the biggest single trades coming about a half hour after the announcement when someone bought 2,000 strike calls expiring in November and December for about $510,000. There was also a flurry of heavy call trading activity in the hours before the announcement, just shy of 2 million in calls of various strikes and expires trades before 3 p.m., including some trades that carried signs of indiscriminate and rushed buying, indicative of someone eager to get a trade in on or get in on a trade. So yeah, that does not look good, right? Like that definitely doesn't look good. But then we go here. Wall Street's existential crisis over perpetual futures, the 24/7 security on steroids, just got urgent. So, perpetual futures or perps are blockchain enabled 24/7 traded, never expiring futures that are threatening the trading economics of traditional Wall Street exchanges. President Trump on Wednesday teased a path to CFTC regulation of hyperliquid. Perps gained attention in the run up to SpaceX's June IPO by allowing overseas buyers to purchase a vehicle tied to the offering before its public debut. So there's an old trader saying, don't put on a position that won't let you sleep at night. Perpetual futures, known as perps, in short, are literally designed to do the opposite. Blockchain enabled 24/7 traded, never expiring futures, a label now legally contested by the Chicago Mercantile Exchange, are growing so fast overseas that they almost stole the show for the biggest IPO of all time and knocked 18 billion off the combined market values of the CME Group, CBOE Global Markets, the Intercontinental Exchange, and Miami International Holdings in 2 days. Now, after a press conference by President Trump on Wednesday that teased a path to CFTC regulation of Hyperliquid, the fast growing decentralized venue for trading perps, Wall Street's game plan may need to lean more towards an embrace than a fight. In its simplest form, you could think of perpetuals as a bet that never expires. They could track almost any asset class, trade around the clock, and offer tons of leverage. Investors are worried perps will disrupt the business model of the traditional exchanges, which make a substantial amount of money off the so-called roll-in derivatives, where traders extend the life of an expiring contract by selling a near-dated contract to buy a longer-dated one. Perpetuals never expire, negating the need to roll contracts and depriving exchanges of a lucrative revenue stream. While the initial approval of perpetual futures trading in the U.S. has been limited to cryptocurrencies, the president's comments this week suggest regulated perp trading may soon be available on traditional asset classes like stocks and commodities, which are booming in popularity on Hyperliquid this year. Traditional exchange economics could be in question, said one current board member of a publicly traded exchange who requested to remain anonymous. Perpetual futures, zero DTE expansion, extended trading. They're all responses to an increasingly competitive market where investors expect continuing access. Brokers and exchanges have extended trading hours for several years now. Charles Schwab's TD Ameritrade pioneered 24/5 trading in 2018. The London Stock Exchange will join next year, and now most brokers, along with CBOE, offer trading in major securities, including index options in some form on all but Saturdays and Sundays. The advent of monthly, then weekly, and eventually same-day options expire also expand the calendar from the inside out. In that context, perpetual futures, born of crypto origins, an asset class whose appeal stemmed in large part due to constant access, look like a natural next step. But some investors and observers point to the product's internal leverage as a cause for concern and controversy. So yes, I would definitely, yeah, definitely hype that. So and then it gets into like Wall Street adoption. Maybe we'll see. We'll have to see how that plays out. But this is a big thing. This is a very big thing. If Hyperliquid does find a path to being regulated, and all of a sudden the perpetual futures, Wall Street is able to get, and again, the thing with Wall Street is like, yeah, okay, maybe um they lose some money on their rolling futures, but they will gain it back by all the sales of this new product in the perpetual futures. So again, I'm not ready to cry tears for them that like, oh boy, this is really going to go bad or whatever. But we'll see. Well, like I said, we're going to keep an eye on this. If anybody wants to go, I did a whole episode on perpetual futures and breaking them down, letting you know what that is and what it's all about. I highly recommend, if you're interested, go check that episode out. So, but I'm sure, but like I said, I wanted to bring this up because I am sure that this is going to continue to become a very hot button topic over the next few months. So, all right, continuing along here. So, Trump bemoans the Fed interest rate policy, says the U.S. should be paying much less. So, President Donald Trump on Wednesday renewed his attacks on the Federal Reserve, saying the central banks shouldn't let positive economic news stop it from lowering interest rates. Chairman Kevin Warsh is doing a great job at it. Trump, who also complained about other countries having much lower policy rates than the U.S. Well, um, look. I think Trump can kind of bemoan this all he wants, but what he should have done is not attack Iran. Not attacking Iran would have been a wonderful thing because the inflation was coming down until he decided to attack Iran. Then we got the side shock, which sent inflation surging back up. That freaks the Fed out. Then the Fed basically says nope. I think in a certain respect, he's probably lucky that the Federal Reserve has been standing pat the way that it has, because they very easily could have gone the other way and said, okay, we're going to start hiking interest rates back up to try to cool things back down. So unfortunately, I think his window for getting rates down has basically it's gone for the moment. I think it's gone. I think he can bemoan all he wants about interest rates coming down. It's not going to happen. Not with this turmoil in the bond market. Um, when we go back to this with the rates here, yeah, when you're seeing the 30-year up at almost 5.3%. Yeah, that is not going to fly. It's just not going to fly right now. So, um, yeah. So, all right. Now let's get into. So, it was a wild week when Scott Bessent was schooled by the bond market. So, the Treasury Department's announcement of a bond buyback stemmed a sell off, but not for long. So, Brian Jacobson was heading into a meeting Wednesday when Treasury Secretary Scott Bessent threw a major curveball at the U.S. bond market. A day earlier, yields on the 30-year U.S. Treasury had touched near two-decade highs, and investors were on edge. Jacobson, chief economic strategist at Annex Wealth Management in Brookfield, Wisconsin, had trimmed holdings of longer term bonds and portfolios he managed for clients. Now, in the wake of the Treasury Department announcing that it would at least double buybacks for long term bonds, the market was moving against him by rallying. The maneuver, Jacobson said, clearly wasn't just a technical adjustment, but an attempt to try to tame the moves in yields. But he also worried, viewing it as a superficial fix that wouldn't last, and he was right. Over the next 2 days, Bessent's victory proved fleeting as investors gradually imposed their will on the bond market, snapping yields back to where they were before the gambit. And again, here you can see U.S. Treasury yields here, the 30-year yield and a 10-year yield shooting up, as we said. Now let's take a look at um, yeah, so investors remain anxious about stubbornly high inflation, mounting federal debt, a deluge of corporate borrowing to fund artificial intelligence investments, and a new Federal Reserve chairman whose approach to setting interest rates remains enigmatic to many. For some, the Treasury Department's response only added to the sense of a typically staid market gone disturbingly off kilter. So I don't know about disturbingly off kilter. I'm not sure about that one. But let's take a look at, so let's follow this through the week here. So we start out here on the 17th and 18th, Monday and Tuesday. Bonds are getting hammered, and Wall Street says the rout won't end anytime soon, with yields on the 30-year U.S. Treasury at a 19-year high. Investors predict a new era in the bond market, and it looks a lot like 2007. Like, yeesh. So we see in this chart here, 30-year government bond yields. We got the U.S., France, Japan, and Germany. You could tell here that they are all heading in the wrong direction. France is up to 4.89%. Japan is at 4.135%. Germany is at 3.773%. Again, us well over 5%. So there for different countries around the world, but a sell-off in global bonds is driving up borrowing costs for governments, businesses, and families across the developed world. Wall Street sees no end in sight. Bond yields are at a 19-year high, and investors are blaming the rout on everything from the continuing U.S.-Iran conflict, which has stoked inflation worries, to the deluge of tech company bonds vying for debt funds cash. They are also anxious about budget deficits and a lack of clarity from a new Federal Reserve chairman. Few see eye to eye on exactly how much weight to put on any one factor, but most agree on one thing: none of these conditions are likely going away soon. What's more, many see something larger driving the sell-off: the economy's resilience in the face of interest rates that were once considered high enough to slow growth significantly. In the 08-09 financial crisis, ushered in an era of ultra-low interest rates, then current market conditions might mark a return to the way things were before that downturn, some say. Investors are hesitant to buy longer term bonds because of the risk that rates could move higher and possibly much higher, even if the Fed doesn't move immediately. So basically, this is a normalization, said Robert Tipp, chief investment strategist and head of global bonds at PGIM Credit. Yields on government bonds, which rise when bond prices fall. Remember that. Yields and prices are inverse of each other. So as yields go up, bond prices are going down. Have reached multi-year highs in recent days. So far, the sell-off has been limited to bonds. Stocks are hovering near record highs, and corporate earnings are still robust, signs that higher interest rates aren't squeezing economic growth just yet. Still, a sustained move higher in yields will have consequences well beyond Wall Street. One of the most direct victims is the government itself, which will be forced to pay higher interest rates on its growing pile of debt as older bonds mature and are replaced by new ones. Even before this year's run-up, interest on the debt was consuming a bigger slice of the federal budget. Now, nearly $1 in $5 of revenue goes to interest payments. Over the past half century, federal interest cost averaged 2.1% of GDP. That figure is slated to hit 3.3% this year, on its way to 4.6% in 2036. All right, now let's go. Let's keep going here. So bond rates getting hammered. Then we have Bessent moves to curb the Treasury yields, putting new pressure on Warsh's Fed. So the Treasury said it would increase buybacks of long-term debt after a sell-off pushed yields to uncomfortable levels. The move aligns with Bessent's long-running focus of lowering the 10-year Treasury yield. Critics warn the strategy could fuel inflation, shift more borrowing into short-term bills, and pressure the Fed to support fiscal policy. Warsh may have to explain at Jackson Hole how he sees the Fed's relationship with the Treasury and the bond market. What's fascinating here on a sidebar, and this is just wild. I don't understand why is it, and I keep saying this, I know the answer, but I keep asking the question, why is it that with the financial press, why is it that it's like, why is it that Scott Bessent and Kevin Warsh and the president, why are the three of them not allowed to work together to address all of the financial problems in the United States? Why is that? Why is it every other president is allowed to come in and work with the Treasury Secretary, work with the head of the Fed to basically try to figure out, like, okay, how do we work together? How do we get this fixed? But yet, for some reason, with Trump, it's like he's not allowed to do that. He's not allowed. He can't talk to anybody. He can't, because he might influence them. Newsflash: in the real world, the president has tremendous influence on everyone. Okay, including the Treasury Secretary and the head of the Fed. Okay, can we please stop with this fantasy world of, like, every other president just comes in and the other presidents and other administrations just, they don't have their wants, they don't have their disagreements with these guys, or get along well with these guys, or try to get everybody rowing in the same direction. It is literally a fantasy world to think that, the president is not going to call in the head of the Fed and not going to call in the Treasury Secretary to try to sit them down to try to work on our country's issues. So I just asked the common sense question: why would you not want these individuals working together to solve the problem? It's ludicrous. But anyway, that's a soapbox item on a sidebar. Okay, so then we get into, Bessent's efforts in the Treasury market so far haven't worked. Here's what else he can try. So Bessent tries to calm the markets down. It doesn't work. Now, Treasury Secretary Scott Bessent said Thursday he has a big toolkit to aid pressures in the government bond market. While he didn't name them specifically, Bessent has several options, including duration of the government's holding, ramping up the bond buyback program, and changing the duration composition of the Treasury portfolio. Bond yields moved higher Thursday despite the Treasury chief's assurances. So Scott Bessent came out and basically said, okay, we got this, that, and the other thing. And then he comes out and we basically Bessent says that the Treasury buyback operation could be more than $4 billion. So Treasury Secretary Scott Bessent said a debt buyback program announced Wednesday could be larger than $4 billion, with the upper limit. In remarks to CNBC, he said current yields don't reflect market fundamentals and said liquidity, particularly in the 30-year bond, is weak. Yields briefly eased as Bessent spoke before turning higher yet again. So now again, um, why did the market shrug this off? Well, it's $4 billion. I mean, it's nothing. I mean, the bond and the treasury markets are enormous. I mean, you're talking about I don't even, I mean, 10 trillion dollars, 20 trillion dollar. I mean, you're talking an insane amount of money and size to that market, and to come out and basically say, yeah, we're going to double it, we're going to do 4 billion, like that is literally a drop in the bucket. It is nothing. And so the market basically looked at that for a minute and said, huh, and then completely shrugged it off and said, yeah, that's not going to do anything. So that's what basically, so he makes this announcement on this plan that he wants to, again, he's going to try to increase this buyback operation to 4 billion. Okay, I don't really think that's going to do very much at the end of the day. And then we get this kind of interesting take on it. So US bond intervention is like paying your mortgage with your credit card. JP Morgan Sullivan says. So US Treasury buybacks may offer temporary relief but risk merely shifting the debt problem down the road, according to JP Morgan's James Sullivan. Yes, well, he's absolutely correct. Surging government and corporate debt supply, alongside waning foreign demand, could keep upward pressure on yields. Higher bond yields are increasingly competing with equities, making investors' asset allocation decisions more difficult. Yes, I would totally agree with that. So the Treasury is effectively buying back longer duration bonds while issuing shorter dated bills, a strategy that can provide temporary relief but leaves the underlying debt burden intact. James Sullivan, JP Morgan's co-head of global fundamental research, told CNBC Squawk Box on Friday. The U.S. Treasury Department, led by Treasury Secretary Scott Bessent on Wednesday, announced it would at least double the size of its government debt buyback starting September 9th and running through November 4th. Sullivan compared the approach to refinancing longer term obligations with shorter term borrowings. So the Federal Reserve did something very similar to this. Let's go back to like 2010, right? We're coming, the financial crisis has hit rock bottom. We're starting to come out. The Federal Reserve did something called Operation Twist, where they basically manipulated the long end and the short end of the Treasury yield curve. So if we go back to this for a second, so let's look at our chart here. So again, at the high end, you got the 30-year bond, right? And then on the low end, you've got the 1-year bill, the 6-month, the 3-month, and the 1-month. So what they are effectively saying here in this article is that they want to effectively buying back longer duration bonds while issuing shorter dated bills. So again, if we come down here, so again, it's buying the long and then issuing the short here, issuing more of the short-term bills. And thus like I said, and when the Fed did it, they called this Operation Twist to try to manipulate the long end and keep interest rates on the long end artificially low. The Fed did this for a little while and then basically stopped and then just went full-blown quantitative easing. And that effectively is what the market wants to see. The market wants to see them turn the money printer back on. They want to see the money printer back on, and then that will, if they do that, again, the $4 billion, that's not moving markets. That's a blip in the screen. It's not doing anything. That's why the market shrugged it off, and the rates shot right back up. Now, hold on a second. If Bessent comes out and throws out a big number like, oh, wait, we changed our minds, we're actually going to jack this up to maybe 10 billion, 20 billion, 30 billion, maybe 50 billion, then all of a sudden, you'll see things calm down real quick. But to the point of this article here, what this guy's saying is absolutely true. I mean, basically, this is just, again, it's more of just kicking the can down the road. It's a little bit like paying your mortgage with your credit card. It can work for a while, but eventually the mismatch starts to become more obvious. Like, yes, and yeah, and I agree that the intervention may help manage borrowing costs in the near term, but Sullivan's concern is that it does little to address the bigger problem, a mounting wall of government and corporate debt that ultimately has to find buyers. Governments trying to control markets is not a particularly attractive story most of the time. Um, and the problem is that these games worked. They were a lot easier to do when, 10 years ago, 20 years ago, when we had a lot less debt. These games were, it was very easy for the Treasury and the Fed to kind of pull some of these things, and it had the desired effect they were looking for. But now, again, it's like, think of it like, you're on a cruise ship, or you're on a destroyer, a military battleship, a destroyer, and you're trying to turn this thing around, right? Well, you can't turn that thing on a dime, man. That thing's got to be very carefully, it's got to be very carefully turned around. You got to watch the weather around you. You got to, see, okay, what are the seas? What's going on? It's not that easy to do. That's the point. It's not that easy to do. And now, look, I want to be fair to Scott Bessent here. I don't want to beat. I think a lot of Scott Bessent. I think Scott Bessent is the best Treasury Secretary we have had in a long, long time. I think, well, I should say, I hope. I hope that when he is done, I hope he sticks around for the whole 4 years, and I hope that when he is done, that we look back and we say, man, that guy was incredible. That guy was one of the greatest Treasury secretaries ever. And I think, Janet Yellen, I just think I did not think much of Janet Yellen. I think Janet Yellen was a hack. I think she was a fraud. I think she was absolutely one of the worst, if not the worst, Treasury secretary we have ever had. And the problem is that most people out there don't understand how the Treasury works, and the Treasury they have a way of manipulating a lot of things, which I'm going to show you guys here in a minute, which most people can't diagnose, or can't get into, and they won't explain it to you. If you're like watching CNBC or Fox Business or Bloomberg, maybe Bloomberg might, on a 5-minute segment, they might have somebody come in to talk about it real quick and then jump off. But for the most part, you're not going to get anybody to talk about it. They'll talk about it in a certain respect on here, basically just to give, to put out articles like this. Bonds are getting hammered in the Wall Street rout, and this was, the wild week when Scott Bessent was schooled by the bond market. I mean, they love to put out articles like this kind of like, oh, we gotcha, Scott, we gotcha, dude, you stink, we gotcha. No, not really. Like I said, I think a lot of Scott Bessent. I think he is tremendous. I think he's so far. I would give him an A+ on his management of the Treasury, and the things that he can do to help the U.S. economy. The guy has done a phenomenal job. I think he does have a couple tricks up his sleeve. I do think that there's a couple of things here. However, there does come a big however. Every decision that he has is going to have trade-offs, and it's going to have consequences. And some of those consequences will be short term, and some of those consequences will be long term. And like I said, he is trying to, turn a cruise liner around, and that is, you can't do it quickly. It's a slow process, and the problem is that his options are beginning to narrow. And in my fear is that he could eventually be accused, or get accused, and might very legitimately so, might get accused of basically doing some of the very things that Janet Yellen was doing. And what I mean by that is, let's finish up here for just a second. So, um, so like I said, that this was just to recap this for a second. So Scott Bessent, we start the week off where bonds are getting hammered. Bessent comes out and says, yeah, no big deal. We're gonna buy a little more. We're gonna do this. We're gonna do that. The market reacts kindly for about a day, and then basically, efforts they don't really work. Then he announces, okay, we're gonna double the buyback to 4 billion. The market kind of looks at that, shrugs, it goes right back, and now you've got basically the critics coming out, basically saying like, okay, he can kind of play these games with the short and long end of the yield curve, but ultimately you're just kicking the can down the road, which is not wrong. But then we get into this. So, Fed officials say that the rate hike is necessary if inflation doesn't cool. The minutes show. Now we're looking at talking about the Federal Reserve minutes here. So, despite growing hawkish sentiment, I don't think you're going to see the Fed hiking, said one top market analyst. So, many Federal Reserve officials have agreed that raising interest rates might be necessary if inflation does not cool, according to minutes released on August 19th. The Fed voted 9-3 on July 29th to keep the benchmark federal funds rate at its current level. Some participants believe that current financial conditions might not be restrictive enough to support a return to the institution's 2% inflation target. Most participants anticipated that inflation would step down over the rest of the year. So the rest of the year, not a couple months, the rest of the year, as the effects of tariffs and early energy price increases wane. But many participants noted the possibility that inflation might be more persistently elevated. A chorus of officials also stated that 64 months of inflation above 2% could affect inflation expectations as well as wage and price setting decisions. Several participants remarked that successive supply shocks have repeatedly delayed the expected return of inflation to 2% in recent years, adding to concerns about persistently elevated inflation. So, um, here's what you have to understand. Um, what One of the things what is the main thing that drives inflation? Government spending. Government spending drives inflation. And this is why I think you could very easily hypothesize that inflation will never come back down below 2%. Because again, on a large part because of the government spending, because of all the spending on, when we go back to like these articles, I'm trying to think of the article here with the percentage of government spending right here. This is a big reason. These payments to individuals, like you put this money into people's hands, and then what do? Well, they're going to go out and buy stuff, right? Now, um, consumption is a giant part of GDP, but it's also a giant part of why we're still seeing this elevated inflation years later. It is the government spending is what creates the inflation. And we have to get, again, it gets back to the argument of like, we've got to get this spending down. We have to get it down. It is not going to go back down. It's not going to get back to 2%. It's not going to go below 2% unless you cut the spending. That's just the reality of it. They could sit here. You can ask the Federal Reserve to do whatever. If Congress isn't going to act, if they're not going to reduce the spending, there's not really a whole much the Fed can do. And the Fed, yeah, they can jack up interest rates, and that will bring things down, but it'll also cause a massive recession. That's just where we're at, man. I mean, but I'm telling you this for a reason. So just bear with me here for a second. So, and then here we are. Central banks are stuck in a rinse and repeat cycle of crises. By becoming market makers of last resort, policymakers are pumping up leverage and risk. So central banks may be accidentally subsidizing. I love accidentally subsidizing government borrowing through their efforts to prevent a repeat of past market blowups. And policymakers are starting to worry that anti crisis lending facilities could even be interfering with their own monetary policy. The source of the problem is the switch from central banks being the lender of last resort to, in 2008 and 2020, also being market makers of last resort, ensuring corporate and government debt markets keep functioning. During a crisis, support is often essential to prevent a downward spiral that destroys the financial system. But backstopping markets removes a key risk and encourages more borrowing, especially for the hedge funds that now own trillions of dollars of US treasuries. So, I want to keep there. By backstopping markets, it removes a key risk and encourages more borrowing. What is that key risk? That is called the moral hazard, ladies and gentlemen, the moral hazard. When you remove the moral hazard, you invoke a ton of new risk taking because they're basically like, oh well, they're going to bail us out. And I have said this before, that the Fed has created the all bailout all the time economy. And these, again, this is what Wall Street expects. Wall Street expects, oh, okay, this is the era that we're in. We're going to blow it up, and then they will always be here to bail us out. Ironically, vulnerability is created by mechanisms that were introduced to reduce vulnerability. Um, so it's a bit like a whack-a-mole kind of story. Now, I want you to this chart here should be shocking. It's not as shocking as the next chart I'm going to show you, but it should be shocking. Repo repurchase cash borrowings. Look at this explosion of repos here. So this is $1 trillion as of April 30th, 2022. Now we get all the way up to August 31st. We are at 2.99 trillion, almost $3 trillion in repo repurchase cash borrowings. The scale is extraordinary. The Dallas Fed estimates hedge funds ended last year with 2.4 trillion of treasuries, up from 600 billion a decade earlier. Because the profits on each trade are tiny, hedge funds have to leverage as much as 100 times to get worthwhile returns, creating new risks. This might sound abstruse, but in 2020, it was the Treasury basis trade blowing up that forced the Fed to intervene. In 2020, signs of trouble in the swap trade pushed President Trump to retreat from his tariff plans. So signs of hedge fund, what's called the Treasury basis trade. So let's go back to 2019 here for a second. Now here, the Lords of Easy Money, right here, Christopher Leonard. I got a couple books here I want to show you. Lords of Easy Money, right here, Christopher Leonard. Once I detailed out, I have told the story from this book. I've covered it in the Lords of Easy Money series. So basically, 2019, the Federal Reserve basically unknowingly allowed hedge funds to basically take over the Treasury market, where they had basically put in what they call the Treasury basis trade. Now, again, understand, it's a very simple trade. It's just trading some overnight securities. You make a tiny little profit. Now, this trade works when rates are at zero, like they were for a decade, and it works really good if rates are just stable for a certain period of time. But once interest rates start to move, that basis trade gets blown up real quick. And we've already seen several examples of this. I would also go back last week. I talked a little bit about this book, When Genius Failed. This is the story of long-term capital management in 1998. Why did long-term capital management blow up? They blew up because they too, I mean, there was a number of reasons, but one of the biggest reasons was they too were running the basis trade. The kind of the irony of what happened there with long-term management was that Wall Street didn't shy away from what long-term capital management was doing. They embraced it, and they basically said no. They said, oh no, what they were doing was actually pretty good, and we can make some serious money off of it. Then you get to last year with the Japanese yen, and even this year with the Japanese yen, with what they call the carry trade. So the carry trade is just the same thing as the basis trade. It's just you're doing it with currencies instead of doing it with treasuries and the repo market. And basically the same thing happened with the Japanese carry trade. Like they use the yen, and the interest rates there in Japan weren't moving, and then all of a sudden the Bank of Japan started moving interest rates up, and interest rates went from negative back to even, and then back into positive territory for the first time in a long time. And their carry trade basically blew up, and we're threatening for more of that to blow up. Now we got the background there. So now here is the size of the hedge fund treasury basis trade. And this, I mean, this is shocking. Absolutely shocking. I mean, look at this. So 2019, when this blows up, and remember, this you might be sitting there right now going, well, wait a minute, I don't remember any of this. I don't remember the Federal Reserve having to come in and bail out the hedge funds when the Treasury, when their basis trade blew up in 2019. I don't remember any of that. Yes, that's because COVID happened, and then COVID swept it all under the rug. But yes, the Federal Reserve had to dive in, and then the other thing is the Federal Reserve kept the bailout extremely quiet. Like one day they just dumped about $400 billion into the market and said, "Oh yeah, we're just doing some things or whatever." They neglected to mention that they had to bail out all the hedge funds that were about to blow up. So we have this, but then it comes back down April 2022. So a couple years later, kind of coming back down to normal. And then ever since then, the last 4 years, we've just seen this absolute explosion up to $832 billion. 832 billion of the treasury basis trade. So it's crazy. So in 2025, signs of trouble in the swap trade pushed President Trump to retreat from his tariff plans. I don't really know about all that, but Pill worries that the reassurance central bank policy providers bleeds into monetary policy by boosting borrowing. This in turn keeps government debt yields lower than they otherwise would be. There's lots of gilts to be bought, he says. How do you support that buying of gilts? You make it attractive. How do you make it attractive? Well, there are some imperfections in the market. So those imperfections create profit opportunities, but they're not very big. So how do you make them more meaningful? You allow leverage to build up. That's good for the government because it gets to sell the gilts at a lower yield than it otherwise would. Now, I should tell people, what is a gilt? A gilt is the British bond. So in America, we sell our bonds, they sell gilts. So now we know what a gilt is. So it's good for the financial sector because they're able to extract these rents effectively, and it's good for the central bank because the market seems to be liquid and functioning. But all of those things are true until they are not. Yes, when it goes wrong, the more leverage, the worse the problem, and the worse the problem, the more likely it becomes that central banks have to create yet more special tools to address it. That then spurs the next buildup of leverage. So, and again, it goes down in here. So the leverage here is the key thing. The leverage. And this is, I mean, this literally by these hedge funds is just, I mean, this is just nuts that they have gone this deep and this far with the basis trade is just, it's absolutely, I mean, the amount of leverage here is just, it's just off the charts, man. I mean, it's, and Lord help us, because the next bailout that they will come crying for this will not be a couple $1 trillion. This will be 10 trillion, $20 trillion. I mean, it'll be an astronomical amount of money. And then we get in here to the Fed's balance sheet. And then let's look at, we go back 10 years. We see what happened during COVID. So after the financial crisis, so we go back, if we go back the max here, again, we go back to 0809. The Fed had 889 billion. 889 billion on their balance sheet back in 07. And then you get the financial crisis that balloons them are up to 2 billion. Then we get all the quantitative easing, and we get up to about 4.4 trillion dollars. Then we start coming down on that a little bit. We get down to 2019 basically, and then back up a blip, and then we get the financial crisis, and then boom, we are off to the races, and we blow all the way up to almost $9 trillion. Then we get the balance sheet back down here to about 6.5 trillion. And now I wanted to show something here. So we hit here. This is December of 2025. Okay, so we're down to $6.5 trillion. And where are we at today? We see this going back up. So the Fed has, they have turned the QE. I love what Zero Hedge. So Zero Hedge calls this the QE, not QE. Meaning that it is quantitative. If the government is, if the Fed is printing money, and they're buying up bonds and treasuries and everything, that's a form of QE. So we're seeing the balance sheet go back, and again, not dramatically, nothing major, but it's going back up over $200 billion here in just the last 6 months, or I should say last 8 months. Um, but again, and they're going to continue this spending through November. My guess is that again, what does the market want to see? And what did we see in the earlier article? They're expecting Bess or not Bess, Kevin Warsh, the Fed chair. He's got the Jackson Hole Symposium coming up here very shortly. It has been traditional over the last 15 years or so for the Fed chair to give kind of a bigger speech at the Jackson Hole Symposium. So they are expecting. The expectation is for Besant to come out, give this big speech, let the market know what's going on, what he's going to do, give all the forward guidance that Besant has told him that he doesn't want to give them. But that is their expectation. And what they want to hear is they want to hear that there is going to be. I can already tell you, they want to hear that there is going to be a massive expansion. They want to hear that they're going to turn the spigot back on and that they're going to buy. That the Treasury is going to buy more, the Fed's going to buy more, and they're going to turn this on to the tune of, I would even say, a couple $100 billion. They're going to pump in 100, 200, 300 billion to try to calm things down. Which again, it would work. It would work. I mean, don't get me wrong, that would work in the short term. That would calm things down real quick. But there's a big but to that. If you're Kevin Warsh and you're trying to put things back again, like you said, like if he's going to work to make real change there at the Fed, he's not going to give them what they want. He's not going to come out and say, he's not going to give them that forward guidance, and he's not going to. He's basically going to say, yeah, we're continuing to look at the situation, yada yada yada. My guess is that his speech, if you will, at the symposium, probably going to be pretty short. Probably going to be pretty short. The markets are not going to like that because it adds to uncertainty. The markets don't like uncertainty, and that's really what that shows. So we'll see here. We will see what happens here. But again, I'm showing you guys how the balance sheet is going back up, ever as slightly, but it's going back up, and they're still sitting on 6.5 trillion. Now, I wanted to show everybody this. This was an article that I had covered. I need to make this a little bit bigger here. Okay. This was from Hudson Bay, and this was written by Stephen Mirren, and this was also Nouriel Roubini, very famous economist and author there. Now, the two of them wrote this article back in July of 2024, and it's called ATI, Activist Treasury Issuance and the Tug of War over Monetary Policy. Now, the reason why I brought this up and want to show, I did a whole episode of this back in 2024. If you want to check it out, I think you should check it out. It's a very interesting topic. But this basically, if we scroll down here, I just want to show you just a couple things here real quick because we don't have the time to go through this whole thing. ATI, Activist Treasury, what was that? I forgot it already. Activist Treasury Issuance. All right, I got that right now. Okay, Activist Treasury Issuance. Okay, so going in here, so ATI. Induced accommodation has loosened the combined stance of monetary and issuance policy. Contrary to the Fed's insistence that monetary conditions are quite restrictive, they are not. And Treasury's issuance policies help explain the persistence of inflation and strong economic growth. So, in other words, back a couple years ago, so Yellen and Powell, again, under the Biden administration, those two are allowed to be thick as thieves. They're allowed to work together all the time. Totally okay if one is completely influencing the other. No harm, no foul, right? It's just Scott Bessent and Warsh that aren't allowed to do that, right? Okay. Anyway, so then it goes into a review of quantitative easing and ATI as stealth quantitative easing. Whereas quantitative easing works by removing interest rate risk from the market and hiding it away on the Fed's balance sheet, ATI works by limiting the production of interest rate risk at the source. The net effect, however, is very similar. So, and then it gets into, how ATI drives liquidity and financial conditions. But then this is the key part I wanted to show this chart here, comparison of quantitative easing and ATI. So how does this work? So if you're doing QE at the Fed, the Fed buys intermediate and long-term debt, creates overnight reserves money. The portfolio balance channel. So the Fed removes interest rate risk by placing it on the Fed balance sheet. The money supply channel. The Fed increases the money supply by creating bank reserves. The bond market effects. Bond prices are higher than they otherwise would be. So bond prices go up and yields go what? They go down. So it has the effect of driving yields. So the Fed's buying it, they're removing interest rate, and they're driving yields down. Other asset prices, the risk asset effects. So other asset prices are higher than they otherwise would be. So in other words, you're driving asset price inflation. You're driving. Remember, there's two types of inflation. You have asset price inflation and just price inflation. So what's killing us right now is price inflation, right? Like the price of services, the price of goods, but asset inflation, in other words, the value of your business, the value of your house, the value of the market securities, that we consider that good asset inflation because that makes us feel good. It makes us feel richer, right? Um, Political economy framework. So politically independent in principle, central bank managing the business cycle via financial markets. Okay, so that's the quantitative easing Federal Reserve side of it. Now, what is the Treasury Department side of it, the ATI side of it? So the transaction. Treasury auctions less intermediate and long-term debt, auctions more short-term bills, quasi money. That's exactly what Scott Bessent just said that he was going to do. He's going to auction more short-term bills. He's going to buy more long-term. He's going to auction more short-term. The portfolio balance channel. So the Treasury reduces creation of interest rate risk at the issuance of those short-term T-bills. The money supply channel. So Treasury prevents reductions in effective money supply because the bills are a close substitute for bank reserves. Now, what is the bond market effect here? So bond prices are higher than they otherwise would be. So in other words, it has the same effect as QE. It's going to drive the bond prices up, which will drive the yields down. Because remember, yields and bond prices are inverse of each other. So if the bond prices are going up, that means the yields are coming down, which means interest rates would start to come down. The risk asset effects. So other asset prices are higher than they otherwise would be. And then finally, the political economy framework. So politically dependent Treasury officials managing the business cycle via financial markets. So again, because again, this whole conversation I've been having all night here so far, like this all ties together. I wanted to go in. There was a method to my madness here tonight. I wanted to walk you through what was happening with the national debt. Then we went into the bond market issue. Then we went into, everything that was happening with Scott Bessent, right? And we come out here. Then we get into our conversation on the Fed, right? And what did they say in our conversation? Oh, this kind of puts the Fed in a pickle. And what's the Fed going to do? And we don't want these guys being influenced, but we need them to do something, right? And now the expectation on the Fed officials here, right? It was like, oh, we got to do something. And then Scott Bessent says, oh, well, we've got a whole bunch of tools in the toolbox, but he doesn't want to specifically say what that is. And the reason why is he doesn't want to say what it is because it's most likely this right here, ATI, which is effectively, it's what Janet Yellen was doing a couple years ago. And it's effectively a form of it's very similar to the quantitative easing that the Fed was doing. And what I wanted to point out is that the Fed is already doing, basically, albeit lightly, they're already back to doing a certain level of quantitative easing. So, and like I'm saying right now, what the market wants, the market wants two things. They want Scott Bessent and they want Kevin Warsh to turn the money printer back on, and they want to ramp this back up, and they want some forward guidance out of Kevin Warsh at the Jackson Hole Symposium. That's what they want in the short run. Whether they give it to him, whether that actually happens, I don't know. That really remains to be seen. We'll have to see what happens there. But like I said, I wanted to go back to this article because as I was thinking about all this week, as this was all unfolding, I was sitting here thinking to myself, like, man, I've seen this playbook, I've seen this movie before. I have a pretty good feeling that what Besant, the tool in the toolbox he's talking about is ATI. And that was kind of worrying me because again, he can do this, but as we saw with the JP Morgan article here, he's gonna get slammed. He's gonna get slammed either which way. If he does nothing, and interest rates continue to fly up, everybody's gonna freak out. And they'll blame him for, oh, Scott, you're not doing anything. What are you doing? What are you doing? Right? If he starts doing this stuff, being more manipulative, if you will, using these tools like ATI, and basically putting a form of QE in there to calm the market down, then he's going to be accused of basically manipulating the market and just kicking the can down the road, which is what he's doing. That's not an untrue characterization of what is happening. But like I said, I wanted to lay this out there, and I know that this took me like an hour and a half to kind of get to this point where I could explain all this and point this out here tonight. So I know it's a lot. I know it's a lot, but I had to take the time to kind of walk through all of this tonight. It is a lot, but the point being here with all of this is that we're getting to the point where the choices, the ability of the Treasury and the Federal Reserve to do something here is getting more and more difficult, because all of these little tools, all these little schemes, they only work to a point, and we're getting to the point where the problem is becoming too big. And my fear, from a political standpoint, my fear is that Congress won't, they will act, but it will be in a very messed up type of way, right? Like, it won't be in the way that we want them to act. It'll be like, okay, let's responsibly cut the spending, which means that you're going to have to, and again, I keep going back to, you need to cut these payments to individuals, right? But what does that mean? In other words, what should they do? Well, first, let's go to the low-hanging fruit. How about anybody who's here illegally? Yeah, sorry guys, no more freebies. And if you don't like that, you can go back to whence you came. That would be the easy one, right? Fraud would be the second easy one. Let's root out fraud, right? Let's get rid of all the fraud in there. The third one is, how about we start taking a look at the massive welfare state? Why don't we start cutting back on some of this welfare, or dramatically reducing the welfare? Okay. However, it will be unfortunately a cold day in hell before the Democrats ever do that, right? They will never, ever do that, because that's their base. And they get elected by promising free stuff and all the goodies. And so that's not going to work for them. So what would they do then? What would they do? I'll tell you what they would do. They're going to come back and blame you. Yes, that's right. They're going to blame you. They're going to say, oh, you know what? Yes, you taxpayers have just had it too good. I'm sorry. Unfortunately, what we're going to have to do here is we're going to have to cut your benefits, because you guys are you gotten too greedy. You've been living too high on the hog. And yeah, those Social Security benefits, we're going to have to cut those back. Those Medicare and Medicaid benefits, yeah, we're going to have to cut those back. Some of those VA benefits, those disability benefits, yeah, we're going to have to cut those back, because you guys have just been getting too much of this pie here. And that's what they're going to try to do. I'm not saying it'll work. I'm not saying it'll be successful, but I'm telling you right now, that's what's going to happen. They are not going to cut the things that they should cut for obvious political reasons. They're going to go after the John Q taxpayer. They're going to blame you for this disaster that the politicians are all responsible for over the last 50 years. This disaster they have brought us to, after one bad administration after the next, they have brought us to this point, and they will turn around, they will take zero blame for any of this. They will blame it on us. They will blame it on the taxpayer. Oh, this is your guys' fault. You guys aren't doing enough. You're not working hard enough. You're not giving enough, right? That's unfortunately what I think will ultimately happen, which is incredibly sad, right? Incredibly sad at the end of the day. So, all right. Um, I've got a ton of stuff left to get to here, but I do need to all right, I do need to break for all right, we're gonna take a pause for a second here. I'm gonna try to get back to some of the things here because we got too much here. I could literally be here for the next 3 hours. We got so much to cover. But all right, let me start with I want to give you guys the economic indicators here for the week. So let's just start out with this. We got it up here on the screen. So our economic indicators for this week. So on Tuesday, August 25th, we got building permits for July. We get the ADP employment change weekly, the CB consumer confidence for August. We get the new home sales for July, the API weekly crude oil stock. On Wednesday, August 26th, we get the core PCE price index for July, durable goods orders for July, the GDP for the second quarter, the GDP price index for the second quarter, the PCE price index for July, personal spending for July, and the 5-year note auction at 1 p.m. On Thursday, August 27th, we get the Jackson Hole Symposium, initial jobless claims, continuing jobless claims, goods trade balance for July, and then finally, on Friday, August 28th, we get the Jackson Hole Symposium at 8 a.m. again. Michigan consumer sentiment for August, and then the U.S. Baker Hughes oil rig count. And those are your economic indicators for this week. Now, what were the episodes that I put out this week? So I put out 5 episodes this week. I basically had 4 new episodes, and I had one strategy room bonus episode from last week's live stream. I put out a bonus episode that were the 7 major issues in the AI world. We could go back and check that out because I actually have a couple articles to cover in that regard. But then on Monday, I did an episode on why is there a shortage of accountants right now? Why do we have this? So a shortage of accountants is beginning to cause disruption with bank and corporate financial reporting and internal controls. The accounting shortage is becoming more widespread after the number of participating accountants has declined 17% from the profession's employment peak in 2019. So again, really interesting problem right now in the accounting world. Check out that episode. On Wednesday, I did another bank news episode, covered a whole bunch of news in the world of banking, which I always like to do. And that episode, and those episodes, the bank news episodes, people really seem to like that format. I just basically get 10 to 12 articles of things going on that happen throughout the week in banking, whether it's bank charters, M&A, maybe some investigations, different regulatory things that may have happened. But I just cover basically the news of banking in a short, 10 to 15-minute episode. And like I said, people seem to be liking that. So continuing to run with that format, but check that out. Then on Thursday and Friday, I did 2 really, really important episodes. On Thursday, I did big tech AI spending has gone off the rails. And so the off balance sheet lease commitments and purchase commitments for Meta, Google, Microsoft, and 6 additional companies are almost $3 trillion. These commitments far exceed their current CapEx, capital spending, which has already turned free cash flow negative. How are these commitments financed? Well, that's a wonderful question. I give a whole example of that in the episode, basically breaking it down from this Wall Street Journal article that covered all this. But what you have to understand is the problem with all these deals that these big companies did is that all these companies are betting on future cash flows that may not materialize, and their free cash flow is, wait for it, it's already negative before these $3 trillion in new obligations actually hit their balance sheet. So can you say overextended? Yeah. So go check that episode out because that is a huge episode that I think will really come back into play in the months and weeks ahead. And then on Friday, I did major hot button issue for me is beneficial ownership information, BOI, finally gone. So the Treasury Department has ended reporting requirements for American small businesses known as the Beneficial Ownership Information, or BOI. The Treasury issued a final rule in the Federal Registry. The final rule also deleted all previously collected BOI information. Now, Congress passed what was called the Corporate Transparency Act in 2021, which required FinCEN, which is an organization that's part of the U.S. Treasury, to create a database that would collect beneficial ownership information on small businesses in the U.S. Now, of course, in classic congressional style, you have to pass the bill to know what is in it. After American small business owners discovered that this new data collection and realized that it was completely unconstitutional, as the lawsuit brought by the National Small Business Association proved in court, the pushback finally began. Treasury killed the database from FinCEN, but banks, however, BOI has not completely gone away because banks are still required to collect BOI on their customers. And this whole issue has not completely gone away. A new administration, like in other words, if the Democrats win in 28, a new administration could resurrect this database idea. And now, why is that? Well, because Congress passed a law. It wasn't like a rule. It wasn't a regulation. They passed a law, and creating this database and collecting this information was part of that law. Now, the Treasury Department under Scott Bessent, they can kill it, which they did. However, another administration could come right back and say, you know what? Sorry, guys, that is the law, and we are going to put this right back into play. We're just going to have, the new head of the Treasury will just reissue another rule, and boom, it is right back. So what we need is for Congress to go back and amend the 2021 Corporate Transparency Act. Now, the problem here is there any hope that they will go back and they should have amended this thing. This should have been taken care of over a year ago. This should have been one of the first things that Congress did with the new Trump administration, but they have done nothing. So the possibility of this coming back like a monster, like the villain in a monster movie, yes, this could rear itself back up again. But at least for the moment, we celebrate a big win for the moment with this being killed off by the Treasury. So we don't have to, small business owners can breathe a sigh of relief, at least for the moment. And the banking business will, I'm sure, look for another way to try to, maybe take BOI off their plate. I don't know. We'll see. But again, it's very, very important episode. Really wanted to cover that. So, keep an eye on that. Now, for this week coming up, I want you guys to keep an eye out on Monday and Tuesday. I've actually got a couple episodes coming out on de novo banks. There was the FDIC and the OCC made some changes to de novo bank applications. We're going to take a look at that. And then basically why form a startup bank and how to do it. So we're going to, like I said, the episodes on Monday and Tuesday this week are basically going to address that. I hope that people will find them, hopefully people will find that kind of interesting. Now, on the bank news front, and I'm going to run through this like really quickly here, because I got super far behind. Mortgage applications dipped this week, of course. FOMC members, inflation should tick down the rest of the year. We talked about that with the FOMC minutes. Federal home loan banks are meeting all the housing goals. That's good. Great news there. FinCEN renews their Minnesota GTO. Again, of course, with all the fraud there going on in Minnesota. Consumer credit increases in the second week of June. Enterprise mortgage foreclosures drop in May. Rural Economic Index rises. So Creighton University's index of rural economic conditions climbed to 50.3 in August, rising above the growth neutral benchmark for only the second time in the past 6 months. Let's see here. Pending home sales dropped in July. Industrial production edges up in mining utilities. Housing starts drop. We're going to go over that in a minute. Let's see here. Builder confidence inches up in August. Treasury proposes licensing rule for stablecoin issuers. So the Treasury Department proposed a rule saying that when the Genius Act becomes effective next year, entities may not issue a payment stablecoin without obtaining a federal or state license. So I'm sure there'll be more on that. Uh, um, ICBA President and CEO Rebecca Romero Rainey basically said the Senate made the right decision in the call on crypto. They basically said that they are not going to rush the Clarity Act before the August recess. So that has been put on hold for the moment. The Genius Act final rule will be out by November. That's according to the OCC. Jonathan Gould said the OCC will have a Genius Act final rule by November. However, ICBA says don't publish reporting forms until the Genius Act framework is complete. So, well, yeah. So obviously, it should be complete in November. We shall see there. SEC proposes rules for investment contracts involving crypto assets. So the Securities and Exchange Commission proposed rules that would create a framework for certain investment contracts involving crypto assets. Yes. Can anyone say perps in there? What we just talked about. Let's see here. ICBA and others oppose Albert Corporation's applications to form an ILC. ICBA also opposes Klarna's application to form an ILC. Treasury proposes investment rules for Trump accounts. So the Treasury Department announced proposed guidance governing eligible investments in Trump accounts. Treasury and IRS propose regulations for employer contributions to Trump accounts. So the Treasury Department and the IRS issued proposed regulations providing guidance to employers that choose to make contributions to Trump accounts for employees or their dependents. The CFPB to stop publishing consumer complaints. Camel's proposal should retain consideration of community banks. So ICBA said proposed revisions to the Uniform Financial Institutions Rating System, commonly known as the Camel's rating system, should retain consideration of community banks. Now, I think that the changes that they're proposing are actually pretty good, but we'll see what comes to pass of it. I did do a whole episode breaking down camels. If anybody's interested in that, you could go out and check that out. But continue on here. So ICBA urges modernization of EIN application requirements for corporate fiduciaries. So ICBA expressed concern about IRS procedures that require community bank trust officers to use their personal social security numbers when applying for an employee identification number for a trust or estate for which the bank services as trustee, executor, personal representative, or other fiduciaries. Yeah, I know that's been a practice for a number of years. I always thought that was weird because the employee works for the bank and is working on behalf of the bank. So why am I using my personal social security number for that kind of stuff? It just, I've never really liked that. So hopefully they do something to adjust that. ICBA updating TRID rule could boost lending. So ICBA commended the Consumer Financial Protection Bureau's review of the TILA-RESPA integrated disclosure rule and its impact on consumers, lenders, and the mortgage market. CDFI fund updates certification policy for non-metro customized investment areas. FinCEN, banks flagged $5 billion linked to human smuggling. So that's good. And then ICBA pushes for technology reforms. ICBA told federal banking regulators that progress is being made in advancing innovation, but additional reforms are necessary to ensure that community banks can fully participate in the rapidly evolving financial services ecosystem. So that is my bank news for the week. So, all right, let's jump back to articles here. All right, hang with me for just a minute. All right, I've got 20 minutes here to give you guys probably about an hour's worth of stuff. So bear with me here, and we're going to go through a lot of stuff here real quick. So hang on. All right, so we're going to start Home Depot and Lowe's. I always like to look at what's going on with them because I think they are a great their performance is a great indicator of what's happening in the overall market. So Home Depot reaffirms guidance amid frozen housing market conditions. So Home Depot reported fiscal second quarter results that beat Wall Street expectations on the top and bottom lines. The home improvement retailer also reaffirmed its full fiscal year guidance. CFO Richard McPhail told CNBC the company continues to operate in a frozen housing market conditions. Now, on the Lowe's front, Lowe's gives muted outlook as it sees pressure in home improvement spending. So Lowe's reported mixed quarterly results as the retailer said it continued to see pressure in home improvement spending. The company updated its full year guidance to the low end of its previously provided range. Lowe's also said tariff refunds provided an 11-cent boost to its earnings per share. So again, this gives you great insight on the surface as to how the housing market is doing, which is not great. Obviously, the interest rates shooting up, that is going to put a dampener on a lot of things. And, home affordability continues to be a big issue. But people might have a lot of home equity right now, but they don't want to tap it because of how expensive it is, because i.e. how high interest rates are. So that's going to hurt, obviously performance at Lowe's and Home Depot. Now let's take a look at what I'm going to come back to I'm going to come back to this for a second because I just want to look at some of the economic indicators here. So U.S. home builder sentiment is still muted by affordability concerns. So the NAHB Wells Fargo Housing Market Index inched up to 35 in August from 34 in July. So confidence among U.S. home builders barely picked up in August as high mortgage rates, rising construction costs, and economic uncertainty continue to hang over the housing market. Here are the main takeaways. I'm not going to get into all this, but yeah, so basically, they're again, the housing sentiment is still muted. Again, you're seeing that in the performance of Home Depot and Lowe's. Then we get into U.S. housing starts dropped in July. So builder sentiment remains weak amid high mortgage rates. So yes, so housing starts fell sharply below expectations in July as home builder sentiment remained muted. So housing starts were down 13.5% in July. Residential permits, another measure of trends in housing construction, were up 5%. But we'll keep an eye on that. And there's some other things here. So U.S. leading indicators ticked up in July. So the Conference Board's leading economic index rose by 0.2% following a decrease in June. So U.S. leading economic indicators edged higher in July as everything except consumer expectations took a turn for the better, indicating that moderate growth could be coming. The leading economic index, or LEI, published by a research group, the Conference Board rose by 0.2% to 99.5, following an upwardly revised 0.1% decrease in June. The index's 6-month growth rate is now positive. So, okay. Then we get over to Philadelphia area manufacturing activity continued to expand in August. The Reserve Bank's Manufacturing Business Outlook survey showed that the current activity index rose to 47.4 in August from 41.4 in July. So manufacturing activity in the Philadelphia area continued to expand past expectations this month, according to a survey from the Philadelphia Fed. So that is good news. U.S. business activity hits a 52-month high in August, according to S&P Global. So while manufacturing output continued to expand, momentum shifted to the services sector, which registered its strongest activity since December of 2024. So business activity kicked into high gear this month, accelerating at its fastest pace in more than 4 years, S&P Global said on August 21st. August S&P Global Composite Purchasing Managers Index, a monthly survey that combines factory output and services business activity, rose to 56 from 54.5 in July. This exceeded expectations and marked the strongest expansion since April of 2022. U.S. business is booming. Chris Williamson, chief business economist at S&P Global Market Intelligence, said in a statement attached to the report. But while manufacturing output continued to expand, momentum shifted to the services sector, which registered its strongest activity since December of 2024. The service industry's spike reflects softer price pressures, higher staffing levels, newer orders, expanded backlogs, and higher confidence. So again, there are good things going on out there. It's not all bad news. Um, Now, here is an interesting side as we get out of the economic indicators here for a second. Here is an interesting side thing here. So, China's private sector faces growing wave of bankruptcies as cash crunch deepens. Established companies across, wait for it, manufacturing, technology, cosmetics, and pharmaceuticals are struggling with weaker demand, delayed payments, and tighter finance. So, China's private sector is facing a growing wave of bankruptcies, restructurings, and liquidations, with companies that have operated for more than a decade collapsing across manufacturing, technology, cosmetics, pharmaceuticals, and other industries. Business owners and economists told the Epoch Times that a combination of shrinking demand, the collapse of China's property market, depleted local government finances, shifting export orders, and tighter bank lending is squeezing companies' cash flow and leaving some businesses with few options other than judicial bankruptcy. So why do you think that's happening? Do you think Donald Trump's tariffs have anything to do with that? Do you think that the shifting of demand and the export orders, you think that has anything to do with, with what's going on with the tariffs? And do you think it's any accident that, manufacturing is continuing to expand, that business activity hits a 52-month high? Do you think that if there's any accident that the tariffs are forcing this to come back? This is what happens. This is what the tariffs can do for us if we give them a chance to work. But then we also go into this. So Evergrande founder sentenced to life in prison by the Chinese regime. So sentencing Zhu Jiyin, a court in Shenzhen, stated that the crimes of China Evergrande Group caused particularly serious social harm. So again, this is the collapsing of the Chinese real estate market. The founder of China Evergrande Group was sentenced to life in prison on August 20th, 5 years after the giant property development firm collapsed under the weight of its debts. Zhu, who is also known as Hu Kaiyan in Cantonese, pleaded guilty in April to misuse of funds, fundraising fraud, illegally taking public deposits, illegally extending loans, and fraudulently issuing securities and bribery. The 67-year-old former tycoon was sentenced in Shenzhen in southern China, and the court also confiscated all of his personal property. That's how they roll in China, man. They just take everything you own. They take everything you own. They take all your assets because you are shameful and you dishonored everybody, even if what you're doing was not your fault. Even if you're just doing what the government told you to do. They're like, yeah, build those houses, build those apartments, build all that stuff, take as much debt as you need, just go, get it done. And then you're like, oh, I think I might be taking out too much. We don't care, just keep going. And they go, and then it blows up, and then they're like, you are a disgrace. You have shamed your people. We will take everything you own and put you in prison for life. Yeah, that's how they roll. Over here in America, when the big bank fails, we just hand the CEO we hand them like a $10 million bonus check and expect them to just go on their way and just go off into retirement. That's then 10 years later we write a book about it and kind of shame them into all the dirty deeds that they did. But over in China, they put your butt in jail for the rest of your life. Just little subtle differences there, right? Okay, now and then we get to, so Trump this week was working on trying to cut a deal with Canada. They could not reach an agreement, so the U.S. is now imposing 50% tariffs on some of Canadians' goods after last-minute trade talks collapse. Canada says it will match the new tariffs dollar for dollar. Now, this is almost comical because if anybody really understands the trade relations between us and Canada, they would know that Canada has put a ridiculous amount of tariffs on the U.S. Some of their tariffs on our goods are as high as 245%. So to say that they're going to match the tariffs dollar for dollar is really a joke, because we were basically the U.S. We were basically subsidizing Canada every year to the tune of like $250 billion. So the idea that this great trading partner of ours, who was basically, we were subsidizing, and then they were killing us with their tariffs. But the minute the shoe's on the other foot, this is all now a big problem, right? I don't think so. Hit them with the tariffs, hit them with the 50%, make it 100%. Let them have it, man. We don't. Yeah, if that's our friend, then yeah, we don't need it. Let's just leave it at that. So, all right, now let me go back to these hedge fund articles here for just a second here. So Ken Griffith says that Citadel unwound more than 80% of risk tied to situational awareness portfolio. So I'm going to be doing an episode, a bigger episode on situational awareness. But Ken Griffin of Citadel told clients in a Friday letter that the company has shed more than 80% of the risk from the portfolio of assets it purchased from situational awareness. Griffin also confirmed that the firm's flagship multi-strategy fund ended July up 5.9%, marking one of its best months since 2022. Man, um, I don't like a lot of the things that Citadel does, but you got to give them props, dude. They are good, man. They're very good. Um, Goldman says that the hedge funds have suffered their worst underperformance versus the S&P 500 in July in more than 20 years of data. So Goldman says hedge funds suffered their worst underperformance versus the S&P 500 in July in more than 20 years. July marked one of the sharpest hedge fund degrossing episodes of the past decade. Hedge funds diversified away from AI stocks in July. Now, you got to believe that a lot of that had to do with situational awareness. Like, they just, I mean, their trades and going bad, just it created a lot of ripples through the hedge fund world. So that's not really that shocking. And then hedge funds are about to jump into prediction markets in a big way. So Cantor Fitzgerald will serve as a broker, meaning it will organize the block trades on Kalshi's event calendars for its clients. Susquehanna International Group will provide pricing and liquidity as a market maker in these trades with Cantor's clients. So Susquehanna, I had reported on that. They were already big into this thing for quite a while, so no real shock there. But like I said, we're going to keep an eye on this because this is going to become a bigger thing. I mean, prediction markets have become massive, but now, Wall Street wants in, man. They want in on this in a big way. So we will see what happens there. And then private credit's next big thing is 1 trillion in British pensions. So a deal that includes Standard Life, CVC, and Goldman Sachs is latest to tap an increasingly popular source of investor cash. So if anybody watched my episode or the live stream last week, and there might be an episode coming out tomorrow at 12 o'clock, just saying, there might be a bonus episode on the private credit conversation I had last week, talking about liquidity and private credit. What do they need? They need liquidity. And like here, private credit giants have found a 1 trillion plus source of capital to invest. Dowdy old British pensions. Yeah, this you see where this is going. That it's not going. Yeah, Apollo, Brookfield, and Blackstone did their own deals over the past year, muscling in on a booming market for legacy pension plans that life insurers are competing to take over from the companies that first sponsored them. Yes, so they're basically a deal in which investors will earmark $2 billion is the latest example of where UK life insurers manage pensions and turn into a source of funding for private credit. So what are they doing? They are looting these insurance companies. That's what you have to understand. This is going to be a disaster of epic proportions. Okay. They are looting. They're buying up these insurance companies. They're investing in these insurance companies, and they are looting these pension funds because they need liquidity to bail them out from all the bad deals that they've done over the last, 8 to 10 years. It's all coming home to roost. They need the liquidity bad. They're going in here. And where does this all tie in? So I want to show you, this was from Ed Dowd. Okay. If you're not following Ed Dowd on X, you should absolutely follow Ed Dowd. So, and this gets really interesting. I'm going to do a whole episode on this. So he's Ed Dowd saying this. I am authoring this article to simply explain the link between Mark Walters, Guggenheim, private credit, private equity, and wait for it, insurance companies. Many of you have seen the recent headlines regarding an individual by the name of Mark Walters, who is the CEO of Guggenheim and his sports empire having to be sold to meet what is best described as a regulatory margin call. Essentially, Mark Walters' insurers lent more than 200 billion of policyholder money to entities tied to his own empire without properly disclosing the affiliations. Regulators and federal prosecutors now want that exposure cleaned up. That is why he is scrambling for roughly 20 billion in liquidity. So in other words, what did he do? Well, let's see here. Guggenheim bought up these insurance companies and then they looted the money in the insurance companies and put it back into Mark's personal businesses so that Mark could go buy the Dodgers and Mark could go buy the Lakers. And the regulators caught wind of this because basically, if a whole bunch of policyholders die and need their money, they're going to be out because Mark, he needed to buy these sports franchises, like so. So Mark is in a very bad way here, but it goes to show you this crazy system of the links between private credit, private equity, and insurance companies right now, and how it ties into your personal finances. You might be sitting on a simple life insurance policy right now, and you've got a disaster waiting to happen in there, and you don't know it, and that's why this needs to be covered. Private credit. Percentage of loans for borrowers that have stopped paying or are on the brink of default is it's the highest level in a decade. Yep, absolutely. And then I thought this was funny here, this picture. This is the Jenga board here. You got Oracle, JP Morgan, Nvidia, SpaceX, Microsoft, and then who's at the bottom here? OpenAI and Anthropic. I thought this was a perfect visualization of the moment. So if OpenAI and Anthropic, if these two fall apart, the whole Jenga collapses completely. And then this is the oh, wait a minute. I didn't, unfortunately, I must have kicked me out. I had the article up from Ed Dowd, but they're not going to give it to me. So okay, so there is that. Now where do we stop here? So okay, just a couple more things to run through here. So, Philadelphia-based Tioga Franklin Savings Bank becomes the fifth bank to fail in 2026. So, the Pennsylvania Department of Banking and Securities closed Philadelphia-based Tioga Franklin Savings Bank and appointed the FDIC as receiver, making it the fifth bank to fail in 2026. The FDIC entered into an agreement with Second Federal Savings and Loan Association of Philadelphia to assume all deposits and purchase substantially all assets of the failed bank. So I'm sure we will have more news on that. So then I was planning on doing a much bigger conversation around AI tonight, but unfortunately, I'm going to have to do this like this is like the 2-minute drill here. So, inside big tech's frantic race to quell the growing backlash to AI, tech companies are holding listening sessions, offering guaranteed jobs, and writing big checks to win public support for the data centers they need. Yeah, it might be a little too late for that, except in Louisiana, where they just basically bought the entire parish. Meta. Trump says any governor or mayor should want to welcome AI data centers in. This is one of the big problems here, where there's this complete disconnect between what people want. Now, other politicians are getting hip to this. So AI data center outrage is showing up everywhere, from ads to elections. With less than 3 months until midterm elections, opposition to AI data centers is becoming a bipartisan rallying cry in a growing number of states. On a major primary election day, a pair of beverage companies seized on data center opposition and released a satirical ad about the facility's water usage. Then we go over here. Politicians who once championed data centers are now bashing them. State governors, including Greg Abbott and Josh Shapiro, showing development of the facilities as anger over AI spreads. So, voter outcry over data centers straining resources has made the facilities a mounting political liability for candidates in this fall's elections. So, Greg Abbott, basically, Texas, he already pulled the plug. Then we go over here to Pennsylvania. Pennsylvania governor signs order curbing AI data centers. So Shapiro is the second Democratic executive to do so, following Hochul in New York and Greg Abbott in Texas. So there again, the politicians they are reading the tea leaves, man. They can see what's coming. And they're basically like, yeah, this backlash is big and it's strong, and we don't want to get in front of that bus. Um, Okay, let's go further into the AI here. Worrisome AI is driving a looming market correction, the European Central Bank economists warn. So economists at the European Central Bank warn heady stock market valuations are likely to suffer a correction, even if they fairly reflect the way in which AI will transform society. History suggests investors will demand higher and higher risk premia as the success or failure of key companies becomes pivotal to the global economy. I would agree with that. Then we get into OpenAI talent exodus raises huge red flag of IPO. I talked about this last week. They had all these key executives running out the door, and the question you have to ask yourself is why would they be leaving right before the company was a cash? I mean, they were going to become stupid rich. They're about to become stupid rich and they're walking out the door. Why is something's going on here? And that is a big red flag. And it was so much that their CEO, so OpenAI's Brockman, brushes off concerns about leadership changes in CNBC exclusive interview. Of course, because what else is he going to say? Oh yeah, we got big problems here, man. We're shafted. Um, Meta faces astronomical consequences as legal fight reaches critical moment in California. Less than 2 weeks after a loss in New Mexico, Meta faces a much bigger legal test in a case of being co-led by California's Attorney General over alleged harms to children and teens. So yeah, that might not work out so hot for Meta. Um, Company AI systems are making mistake and it's creating a trust gap. So internal audits found AI errors reached board members of customers. Only 11% of executives believe their data quality is sufficient, and 89% of investors are concerned about AI accuracy in corporate disclosures. Yes, so AI not turning out all as it's cracked up to be. Then we have this bots now make up more than half of internet traffic. Here's how it's affecting businesses. So, a flood of AI driven automated traffic is hitting websites and it's changing the game. Now, I'm probably going to have to do a bigger episode on this because this is a bigger story. It gets into kind of what they call like the dead internet theory. If anybody's ever heard that, where basically it's just all bots running on the internet. But this is a big deal because this is if you've got this if it's half the traffic is bots, that is really going to hurt small business owners. So that is a big problem there. And then last couple things here. So investors slam the SEC plan to remove the best price rule. Proposal to eliminate decades-old protection draws criticism from Wall Street individuals. I agree with this one. I don't know that the SEC should be doing this. Then we get into top JP Morgan Chase exec warns regulatory proposal could squeeze credit for millions of small business owners. And he's talking about the Basel through 3 capital rules. So we'll see what happens with that. State Farm customers are getting a historic $5 billion payout. Here's who qualifies. The dividend covers more than 59 million eligible auto vehicles nationwide. So if you're one of those lucky people, good for you. That is great. And I thought I might have had U.S. employers' healthcare costs are projected to hike in 2027. Report says employers are expected to see the biggest jump in insurance costs in nearly 2 decades. And then finally, sticker price at some colleges is now nearly $100,000 a year. A worrisome trend, experts say. Yeah, I would say so. I would say so. So, but all right. Whew. That is all I got for you guys tonight. I am going to go into wrap up mode here. I'm going to bring up my story of the week and my quote of the week. But before we get to that, you know what? Let me get my banners. Okay. If you guys are listening to the podcast on Apple Podcast or Spotify, please leave me a review, as that would really help the podcast. Please, if you're listening on Apple Podcast or Spotify, please leave me a review. Make sure to visit thebankernextdoor.com, as I got a lot of good stuff up on the website. Make sure to subscribe on YouTube for the latest and greatest announcements or last minute updates on the channel here. You could send comments to info@thebankernextdoor.com. If you have questions, comments, topic recommendations, anything like that, that's how you get me. info@thebankernextdoor.com. Make sure to follow social media on Getter X and Truth Social. BND, remember, we are on YouTube, Rumble, and all major podcast platforms. We put out new episodes every Monday through Friday at noontime. And then the BND Strategy Room live stream is every Saturday night at 8 o'clock here on YouTube. And then let's get to our story of the week and our quote of the week here. So, our story of the week. So, we are shifting gears a little bit after talking about a lot of IPO stuff, and we're going to decentralized finance, otherwise known as DeFi. So, decentralized finance, or DeFi, is a system by which financial products become available on a public decentralized blockchain network that makes them open to anyone to use rather than going through middlemen like banks or brokerages. Unless a bank or brokerage account, a government issued ID, social security number, or proof of address are not necessary to use DeFi. More specifically, DeFi refers to a system by which software written on a blockchains makes it possible for buyers, sellers, lenders, and borrowers to interact peer to peer or with a strictly software based middleman rather than a company or institution facilitating a transaction. Multiple technologies and protocols are used to achieve the goal of decentralization. For example, a centralized system can consist of a mix of open source technologies, blockchain, and proprietary software. Smart contracts that automate agreement between buyers and sellers, or lenders and borrowers, make these financial products possible. Regardless of the technology or platform used, DeFi systems are designed to remove intermediaries between transacting parties. So yes, so DeFi, a little bit of slowdown in recent years, but still there, still around. So we'll keep an eye on DeFi. And finally, our quote of the week here. This comes to us from President Thomas Jefferson. So, for here, we are not afraid to follow the truth wherever it may lead. And that could be a slogan for the podcast here. Here in the strategy room, we are not afraid to follow the truth wherever that may lead. So, with that being said, I wish everybody a wonderful rest of the night. Have a great weekend out there. Keep an eye out for new episodes this week. I will be back next weekend. Again, thank you so much for listening and hanging out with me. I really appreciate it. And like I said, I will see everybody real soon. Wait, oh my gosh, I almost forgot one last thing. This month is actually the 3-year anniversary for the podcast. We're actually celebrating. So this is a 3-year anniversary for the podcast and the 2-year anniversary for Strategy Room. So it's so again, I was very excited about that. I meant to talk about that at the beginning of the night. Totally forgot about it. I'll have to remember that for next week. But yeah, 3-year anniversary. Hard to believe that it's already been 3 years up here on YouTube and with on all the podcast platforms and everything else. It's been quite a ride for 3 years. But again, I thank you. I thank everybody out there, and I will see you again real soon next week back in the strategy room.